All right. Welcome, everybody. I appreciate you taking time on this Thursday morning / afternoon, depending on where you're joining us from, to spend time with us. I'll kick us off with some introductions and give you a sense of what to expect over the next hour before I pass it to our lovely panelists. So first things first, I'll do some housekeeping items while everyone joins to make sure we're all on the same page. And this will also be posted in the chat in case you join us a little late. So this webinar will be recorded and sent out to registrants in the next few days. Second, please write any questions you might have throughout the presentation in the formal Q&A section. You can find that on the bottom of your screen to the right of the chat button or next to the chat button. And that'll allow us to easily filter through some of the questions and make sure that your questions get answered either throughout the presentation or in a dedicated Q&A session, which is expected to be in the last 20 to 30 minutes of today's webinar. There will also be 3 quick polls throughout the session, which we encourage your input on. They'll be very quick, about 10 seconds, but it'll also give us a better understanding of how to tailor the sessions to your needs, the people who are here. So thank you in advance for your participation in that. So I'll introduce myself first. My name is Natalia Pascual. I am a manager at Agendi in our San Francisco office. I have over 8 years of consulting experience with a specialization in climate and sustainability, and I've developed an expertise over the years in complex greenhouse gas inventories, setting and achieving climate and sustainability strategies, and analysis of climate-related financial risks and opportunities, all of which we'll talk about today. In my time at Agendi, I have been fortunate enough to have supported over 55 different projects in 10 different industries, helping organizations progress on their sustainability journeys. I'll be hosting the webinar today and guiding us through the different sections, but I'll introduce our panelists as well. So I'll start with our Agendi speaker. First, we have Samantha Weinberg. Samantha is a senior consultant in Agendi San Francisco office and is an accomplished ESG professional with a background in international development and technology for good. She has a wealth of experience spanning over a decade, where she has been driving force in sustainability, working both as a consultant for Fortune 500 companies, as well as in-house, championing emissions reductions efforts. Her journey includes impactful roles outside of Agendi at the World Economic Forum, BAI, National Human Rights Council of Morocco, and the African Presidential Center at Boston University. Next, I'll introduce our Caney speaker, Kyle Guest. Kyle is a senior associate in the DC office of Kirkland and Ellis, where he's a member of the firm's ESG and Impact Group. Kyle advises public and private companies across the market on ESG issues, including mandatory and voluntary ESG disclosure, development of corporate sustainability programs, policies, and strategies, ESG oversight, and sustainable finance. He's been particularly focused on issues related to climate change, carbon credits, and the energy transition more broadly. So our speakers, Samantha and Kyle, will go through most of the content we've prepared and answer the questions in the Q&A section of the webinar. So moving us forward, I'll briefly review what we're hoping to cover today. Of course, our goal is to increase the understanding of how the changing regulatory environment will affect California active companies. The takeaways we hope you leave with today are what these regulations mean for your business, how you can best prepare to comply with them, an idea of some immediate next steps, and how potentially Caney and or Agendi can help support you in that. So it's really lovely to see familiar faces in the room. But for those of you who are unfamiliar, I'll walk us through an introduction to Agendi before passing it to Kyle to introduce Caney as well. So for those of you who don't know, Agendi is a sustainability and climate strategy consulting firm. We serve Fortune 500 organizations, and we're proud to be a certified B Corp company and also a CDP accredited solutions provider. We service over 100 different clients and have a global presence with headquarters in North America, the UK, and the EU. And we help our clients with a variety of services. So I'll speed through them quickly to keep this short, but they're split across 5 different pillars. First of which is capacity development, which is really integrated across all of our service offerings. Second is understanding an organization's impact, for example, through greenhouse gas inventories, which we'll talk about more, and also biodiversity assessments, et cetera. Third is through strategic planning, so through materiality assessments, target setting, strategy development. And from there, we support in enabling action and innovation. So think net zero roadmaps, transition planning, supplier engagement programs. And last but not least, we also help in report drafting and disclosures through reports aligned to the many sustainability frameworks and guidance like CDP, TCFD, TNFD, and the rest of the alphabet soup. So Agendi actually partners with Kirkland and Ellis to provide high quality support to our clients collaboratively. And also Kirkland and Ellis happens to be one of Agendi's clients as well. So I'll pass it to Kyle to introduce K&E.
Yeah, great. Thanks, Natalia. As you mentioned, I'm a senior associate in Kirkland's ESG and Impact Practice Group. I joined the firm a little over 2 years ago, and at that time, we just had a handful of attorneys in the group. We now have over 25 with lawyers both in the US and the UK. We work with public and private companies across the market on a pretty wide spectrum of ESG-related matters, from ESG program and policy development to ESG data collection strategies, transactional ESG diligence, preparing voluntary ESG disclosures and regulatory compliance, among other areas. We have different folks in the group that have different focuses, both in terms of the types of projects they take on and their topical focuses, whether that's climate, human rights, DEI, et cetera. I'm personally focused on climate and energy transition issues, which is what brings me here today. And as a quick housekeeping note, you should definitely consult your own counsel about the laws we're talking about today. The intent today is not to provide legal advice, but just to provide some helpful general information.
Great. So quick poll before we get into the content today. Let me put those up just to get a sense of who is in the room and make sure that we can tailor the content appropriately for the rest of today's session. So you should see a poll having just come up onto your screens listing how familiar are you with the California regulations on a scale of 0 to 5, 0 being not at all, 5 being very familiar. We can take the next 5 to 10 seconds to wait for some responses to come in. I see there's lots of responses coming in, so thank you very much already. Do like 2 more seconds. All right. It looks like, I hope you're all able to see this. It looks like we have a very even bell curve here, with some folks being very familiar, not at all familiar, but most of the folks kind of somewhere right in the middle. So I'll leave that with Kyle as you tailor some of the information that we share to make sure it meets where the audience is at currently.
Yeah, I think this is about what we expected. Sort of a hodgepodge. A lot of folks are definitely still coming to grips with these laws. So with that, we'll carry on to an overview of SB253 and 261. The goal here is not really to conduct a deep dive into these laws, but to provide some foundational knowledge and key updates that'll help inform the more practical considerations that we'll be covering later in the presentation. To briefly provide some context here, California has long considered itself a leader when it comes to environmental and climate regulation. The California government has a fairly special relationship with the federal government in that they've been allowed to be a laboratory of sorts for environmental regs and take the lead in this space in certain respects. Historically, the federal government and many states have often linked to the California regulations in the environmental space as models. Also, California's lawmaking activity is especially significant simply because of the size of the California economy and the number of entities that can be directly or indirectly impacted by California's laws. And all that is to say that it's not really a surprise that California was the first U.S. state to pass significant climate disclosure laws, and they're a pretty big deal. Turning to the next slide. So yeah, we all sort of thought the SEC would strike first in the US by finalizing the proposed climate disclosure rule for public companies, but California beat them to it last fall. The two laws we'll be digging in today specifically are SB253, which is the Climate Corporate Data Accountability Act, which requires GHG metric reporting at a high level. And then also SB261, the Climate Related Financial Risk Act, which essentially requires public disclosures aligning with the recommendations of the Task Force on Climate Related Financial Disclosures, which is also known as TCFD. And both of these laws can affect both public and private companies, which is pretty key here. I'll discuss those further in a moment, but first also wanted to flag the perhaps lesser known Voluntary Carbon Market Disclosures Act, AB 1305, which was also passed last fall and already requires subject companies to post certain disclosures on their websites. Broadly speaking, AB 1305 is an anti-greenwashing law, and it requires companies to publicly disclose supporting information for claims they make about the achievement of net zero emissions, claims about the company, a related entity or a company product being carbon neutral or achieving significant GHG emissions reductions. That supporting information would include details about how the climate claim is determined to be accurate, confirmation about whether the claim or underlying data was verified by a third party, as well as details about any voluntary carbon credits used in connection with the claim. And that law applies to companies that operate in California and make claims in California. So, for example, reports made in a public forum, posted on a website, or arguably also any direct communications with California residents. Well, that's not the focus of this webinar. As I'll discuss later, there is some potential interplay between AB 1305 and the two laws that we are focusing on. Next slide. Okay, moving on to the stars of the show, SB253 and 261. Before we get into some of the thornier nuances of the laws and questions around timeline, I'm just going to cover the highlights of what these laws require. Starting with SB253, that requires private or public U.S. companies that do business in California and have total global annual revenues in excess of $1 billion in the prior fiscal year to disclose their scopes 1, 2, and 3 greenhouse gas emissions in line with the Greenhouse Gas Protocol's accounting standards. Subject to the outcome of pending litigation and budgeting considerations, scopes 1 and 2 emissions would be reported starting in 2026, covering emissions for the prior fiscal year. And scope 3 disclosure would be required no earlier than 2027, but no more than 180 days after the initial scope 1 and 2 data disclosure. And that scope 3 disclosure would cover fiscal year 2026. Scopes 1 and 2 emissions are to be audited by a third party at a limited assurance level beginning in 2026 and at a reasonable assurance level beginning in 2030. In addition, scope 3 emissions will be audited at a limited assurance level by 2030 or potentially earlier based on the discretion of the California Air Resources Board, also known as CARB, which is the regulatory entity at the state level tasked with administering and monitoring compliance with this law in SB261. SB261 has the same scope and considerations as SB253, except the revenue threshold is only $500 million. Under this law, in-scope companies must publicly disclose a climate risk report that provides, firstly, on a comply or explain basis, disclosures aligned with the TCFD recommendations or aligned with the fairly similar ISSB climate-related disclosure standard. And second, that report has to contain a description of the measures the company has taken to reduce and adapt to its identified climate-related risks. Now, there's some bad drafting throughout this law, or both the laws really, but given SB261's potentially broad interpretation, companies subject to the law should be disclosing against all 4 TCFD pillars, which the Agendi folks will be getting into in a moment. With respect to timeline for 261, reporting is required to begin no later than the beginning of 2026. Again, subject to pending litigation, and companies will need to publish an updated report every other year thereafter. One last note here, I said that TCFD reporting can be done on a comply or explain basis. What does that mean? Well, if a company has any reporting gaps, they have to explain the reasons for the gaps and describe any steps that will be taken to close these gaps. So long as that happens and disclosures are provided to the best of the company's ability, the law suggests that companies will not be subject to penalties for the reporting gaps under the law. All right, to tick over to the next slide. Yeah, so unfortunately for companies trying to determine whether these laws apply to them, there's currently no formal definition or guidance within any of the California climate laws clarifying the meaning of doing business in California. That said, the California tax code has a fairly broad definition of doing business that many across the market are referring to as guidance at this time. Specifically, the tax code defines doing business as actively engaging in any transaction for the purpose of financial gain within California, being organized or domiciled within California, or having California sales, property, or payroll exceed certain amounts specified in the tax code. So it's a pretty broad formulation. Similarly, the laws don't provide any formal definition of revenues, but the most practical step for determining revenues is likely going to be referring to the entity's annual audited financial statement. That's certainly going to be the easiest step for regulators. Based on a strict reading of the text of the law, you can reasonably take the position that these scoping determinations can be made on an entity by entity basis. Although it is possible that California could take the position that a US company with a published consolidated financial statement, for example, should be referring to the revenues in that consolidated statement for determining applicability of the law. We just don't know at this time what stance they'll take on that because we don't have the enforcement history. One other caveat in this space is that there are instances in which the California tax code treats holding companies as being a single enterprise with subsidiaries. So for the doing business prong, you could see a scenario in which California considers certain holding companies to do business in California by virtue of their subsidiaries' business activities. Hopefully, I mean, it's possible that we could see more guidance around all this terminology from CARB, which has been tasked with crafting certain implementing regulations for these laws, or we might not see any definitions at all. That wouldn't be a big surprise, as there have been other California laws with similar key terms that were never defined. Next slide. Okay, so when preparing to comply with SB253 and 261, it's important to consider them in the context of the broader climate regulatory landscape. So, for example, if your company is already required to disclose scopes 1, 2, and 3 emissions under other state or national laws, and you're ultimately developing your GHG data disclosure for California under SB253, or even in SB261, you'll want to ensure that there are no unjustified discrepancies between the emissions data reporting in California on the one hand, and the data reporting to other regulatory bodies. And if you're a public company, you also want to ensure that your TCFD disclosures for SB261 are consistent with what you're reporting to the SEC in your 10K. On the other side of the coin, you'll also want to be careful to ensure that you're not simply copying and pasting your disclosures in these different regulatory contexts. Companies need to make sure that they're accounting for any unique requirements across the laws. That'll be particularly important as we see other states duplicate California's efforts. We're seeing laws mirroring SB253 already that have been proposed in Washington State, New York, and the Illinois state legislatures, and it's likely that we'll see other states join their ranks in the coming months. In terms of key distinctions across the more significant climate reporting regimes out there, as a reminder, SB253 and 261 affect both public and private companies, whereas the proposed SEC climate rule would only cover publics. Also, the SEC proposal, as currently drafted, only requires Scope 3 reporting if Scope 3 emissions are material to the reporting company, or if they're included in a company target. So if you have like a target to reduce Scope 3 emissions by 50%, for example. In comparison, SB253 in California flatly requires reporting of all relevant Scope 3 emissions in accordance with the Greenhouse Gas Protocol, and SB261 only requires reporting of Scope 3 if it's material to the company. With respect to assurance, SB253 has an assurance requirement for Scope 3, whereas the proposed SEC rule does not. But fortunately, both laws do have similar safe harbors for reasonable errors in the Scope 3 disclosure. And looking beyond US borders for a moment, under the EU's Corporate Sustainability Reporting Directive, known as CSRD, subject companies are required to report on GHG metrics, not only if climate considerations are material to the company's financial performance, but also if such considerations are material to the company's stakeholders. So there's a double materiality analysis, whereas the North Star of SB261 and the proposed SEC rule is generally financial materiality. Ticking over to the next slide. Great. So as written, companies have only 2 years to prepare for compliance with SB253 and 261. However, when Governor Newsom signed these laws, he indicated that their implementation timelines might be too short, and he directed his administration of work at the legislature to address that during this legislative session. One potential way the timeline and implementation or enforcement of the laws could also be altered legally or as a practical matter is through the ongoing budget negotiations between the governor and the legislature. That's because SB253 requires CARB to promulgate detailed regs on the timing, mechanics, and enforcement of emissions reporting by January 1st of next year. Those regulations are supposed to include the deadlines for reporting scopes 1 and 2 emissions in 2026, for example, and the deadline for reporting scope 3 in 2027. SB261 also requires CARB to promulgate regulations on enforcement, and CARB has estimated that it'll need approximately $9 million in 2024 to implement both of these laws and pass these regulations. However, Governor Newsom did not include any such funding in his proposed budget. Given his concerns, there could be amendments to the laws as a part of the budget negotiations, or all or part of the laws can remain unfunded. So we'll be keeping an eye out on the budgeting process and lead up until June 15th, which is the deadline to finalize the budget. Separately, you may have heard that these laws have been challenged in court recently. Specifically, the Chamber of Commerce and other organizations filed a federal lawsuit seeking to prevent the implementation of these laws on the grounds that they violate the First Amendment and the Dormant Commerce Clause, and also are preempted under the Federal Clean Air Act. So a number of attacks here. It's a little too early in the game to opine on the likelihood of success of the lawsuit at this stage, but it certainly doesn't seem like the lawsuit is completely frivolous. And the important thing to bear in mind here is that it could take many months, if not years, to resolve the litigation, and it's unclear whether the court would order California to temporarily halt enforcement of the laws pending the outcome of the lawsuit. But given the effort required for many companies to come into compliance with these laws, and the fact that similar climate disclosure laws are being proposed or coming online in other jurisdictions, companies still may want to consider preparing for compliance while they monitor developments with respect to the budget and this lawsuit. Now, I think we're going to turn it over to Natalia for another poll.
Yes, thank you, Kyle. So as we transition from the regulatory background to the underlying concepts they cover, I'm going to pop up another poll for you all. I've just launched it. This one has 2 questions, again, to get a sense of where you may be in your compliance journeys in respect to greenhouse gas inventory and also climate-related risk and opportunity identification. So take the next 10 seconds or so to respond before I close it out. I see lots of responses coming in, so thank you. All right, I'll give another 5 seconds before closing it out. Okay, great. I'll share the results this time earlier. I think I didn't do that before. So here you can see, from an inventory perspective, we actually have a good number of attendees who have done at least 1 year. A quarter of the respondents actually have done potentially multiple years and gotten it assured. So congratulations to those of you who are in that group. I also see there's about 20% who either haven't started yet or are currently in process, again, of the folks who responded. So either way, we'll make sure to cover some of the details there. And on the climate risk and opportunities side of things, it looks like we're fairly mixed, even split across not yet addressed and also having a TCFD aligned report. So appreciate your participation even halfway about through the session. And I'll pass it to Samantha to discuss some more about the underlying concepts of greenhouse gas inventories and climate risk and opportunity disclosure.
Yes, thank you. So Kyle talked to us about, the details of the law, what it might mean for companies that are in scope. And you might have heard a number of sustainability buzzwords, jargon in there. So I'm going to try to break that down a little bit for folks who might not be as familiar, so that everyone's kind of on the same page about what specifically these laws are asking companies to do and what that means in practice. So we can go to the next slide, and we'll start by talking about greenhouse gas accounting, which is what is specifically required under SB253, as Kyle mentioned. And so really what this means is looking at how a company is calculating their greenhouse gas emissions. The law asks that you do this according to the greenhouse gas protocol. This is really the standard that is used to do these calculations. So definitely no reinventing the wheel here in terms of what California is asking for. They're saying take this standard that's out there that most people are using to do these calculations and apply it to your own company. I want to kind of take a moment to also specifically address the kind of scope 1, scope 2, scope 3 piece here, since that's a big piece of 253 in California in terms of initially requiring scopes 1 and 2, and then kind of follow on to that requiring scope 3. So you'll see here in this lovely graphic from the greenhouse gas protocol that some people might be familiar with, that there are kind of 3 different buckets that your emissions are broken down into. Scope 1 being your direct emissions from company-owned facilities or vehicles. Scope 2 being, for example, from things like purchased electricity, more indirect emissions. And then scope 3 being your indirect emissions that come from all across the value chain of your business. So you'll see all the different upstream and downstream activities that can fall into scope 3 in this little graphic. So the thing to know here is that, as Kyle mentioned, scopes 1 and 2 are the kind of first milestone you will hit for 253 in terms of what is required for companies to disclose and report on. And then scope 3 kind of comes shortly thereafter in terms of what is expected for companies who are in scope. The thing to kind of know about scope 3 and what was mentioned in terms of the difference between, say, this law in California and the proposed rules coming from the SEC is that scope 3 is required regardless, for all companies. But what companies will need to do internally is look at the 15 categories that fall under scope 3 and determine which of those are most material and report against those in particular. Those 15 categories are those lovely icons that you see on the graphic here across the upstream and downstream activities. So, not all of the 15 categories is likely going to be material to your business, but some of these likely are. And so you're going to need to kind of look at them and understand kind of internally as part of what you're doing to comply with the law to understand which of these categories is most material for you to focus on when you are doing your scope 3 calculations and reporting for SB 253. So one of the reasons that greenhouse gas accounting is so important and is really foundational to a lot of other things you might want to do is that without this information, you might not have the data you would need in order to kind of take on other sustainability activities. So the reason that it's so critical that 253 is asking this of businesses is that having this information around your emissions is going to help you do reporting and disclosure along all of that alphabet soup of options that Natalia was talking about earlier, being able to do any setting of targets or think about what your emissions reductions efforts or strategies might look like, and then also feed into any scenario analysis or climate risk analysis that you're trying to do as a company. So having this information is really critical to kind of informing any other activities you'd like to do on your sustainability journey. And in particular, even if you don't fall necessarily under 253, having that information from a greenhouse gas inventory is going to be very important and helpful in complying with 261 and doing your TCFD aligned reporting. It's kind of going into the next slide to talk more about kind of what exactly you need to do to comply with SB 261 and what Kyle mentioned on the task force for climate-related financial disclosures, like what that actually is and means. Really, TCFD was established in order to provide a consistent and standardized framework for companies to have climate-related financial risk disclosures. And there was a real goal here to have transparency on the financial impact of climate. Climate change is happening. It is likely going to impact businesses. and being able to look at that, understand that, and then kind of think about how that would impact your business operations and strategy, and then take steps to mitigate against those risks and find opportunities there as well is pretty important. So TCFD published recommendations that cover 4 categories that you see here. And as Kyle mentioned, it's recommended that you look at all 4 categories when you're trying to comply with 261. So there are disclosures under governance, strategy, risk management, and metrics and targets to consider. There are 11 disclosure recommendations in total that fall under these 4 different buckets. And really, companies need to kind of look at this and think about, the risk side, but also the opportunity side. There are definitely 2 sides to consider. I know it's very risk focused because of the way that the law itself is worded, but TCFD does also ask you to look at opportunities for your business as well. The task force itself was created to come up with these recommendations and then help roll those recommendations out and have uptake. Basically, they were so successful at this that, clearly you can see it was incorporated into California's law. It is also incorporated into laws in other jurisdictions as well. That the task force itself is now going to kind of be disbanded. Its work is complete, but the disclosure recommendations still stand. SB261's implementation will not be impacted by the task force itself kind of closing up shop. The recommendations themselves will just kind of be moved into like maintenance mode with a more permanent entity to kind of monitor those long term. So that's something you might have heard, but just want to address that nothing to be worried about. TCFD is not going anywhere. Just the actual group that created it is going to be closed up so that it can move into a longer term home, essentially, for the recommendations. So if we go to the next slide, we can take kind of a closer look at the kinds of things you're going to be thinking about and needing to look at internally when you're having these conversations, when you're starting to put together your SB261 compliant report. And that is thinking about risks. And like I said, there's a similar framework for opportunities, but we're just focusing on risks here. So TCFD asks you to look at kind of 2 different kinds of risks. So there's the physical risks that you see here on the slide, and I think those are the ones that maybe feel a little bit more obvious, right? What are the physical hazards that you might face in terms of your supply chain or where you are located? So, things that could have an impact on your operations or your supply chain, like cyclones or sea level rise, flooding, the items you see here. So, given where you operate, thinking about how those physical structures and that the physical risk you might face could be impacted. But then also transition risks, which I think maybe are a little less obvious and might not come to mind as easily. But these are the risks that result from changes and actions when you're transitioning to a lower carbon economy. And this is something that, is happening there. That transition is underway. And so understanding, across these 4 categories you see here, policy and legal, market, technology, and reputation, what those risks and opportunities are for your business given that transition is also incredibly important. Thinking about shifts in market behavior, for example, that could change the supply or demand for products or services that your business might provide is going to be really important to kind of thinking about long-term planning around those risks or opportunities for your business when you're coming up with your 261 compliant report. So just to give you kind of the high level on the concepts that are covered in the laws, hopefully this helps in terms of thinking about what you might need to be doing if you are not in a position to already be compliant with the laws, the things you'd need to consider. And so we're going to kind of move into our next section. If you go to the next slide, which is taking all this information of what's in the laws, what are the concepts, what does it all mean, and thinking about what it actually means in practice for implementing things at your company. So Kyle showed you a very lovely timeline earlier, which gave you the whole slew of details around all the different elements of the laws and when they hit and what you need to know and when CARB's going to come back maybe with more information. But this is sort of a streamlined version of what Agendi kind of proposes as the minimum roadmap, we're calling it, to go from today in 2024 to assuming the timeline still stands when you would need to comply in 2026. So 2024 is really the year to prepare, right? You have, I think, enough information about what is going to be expected in the laws in order to think, okay, what do I need to do internally? If you aren't already doing a GHG inventory, for example, thinking about doing an internal data audit, understanding if you have the data you need to do that inventory, to maybe have the conversations around TCFD. Um, if you do have some data, maybe doing a high level scope 1 and 2 inventory using your 2023 data that you do have, just kind of start to get a feel for it, get that process going. It could highlight maybe some areas for improvement in terms of data quality or some gaps you noticed this year that you could take on board going forward. And also thinking about the stakeholders that you need to engage, both internally at the company, who do you need to work with in order to kind of make these things happen, but also externally, are there stakeholders that you need to engage with? Are there suppliers you need to work with to get the data you're looking for? And then also, if you're not already getting assurance on your GHG inventory, maybe proactively reaching out to providers for that. It might feel far away that you're going to need that. However, the closer you get to that happening, the greater the demand is going to be for those services. And starting now means you can build a trusted relationship with that provider by the time compliance is required.
Yeah, and just to echo that point, Samantha, on an assurance, on our end, we're definitely encouraging companies to start their search for a third-party assurance provider now, given that the services will be in high demand because of these laws. CARB's website actually has a list of third-party auditors that it deems to be credible for the purposes of compliance with other GHG reporting laws. So the CARB website could be a good place to start in your search if you're looking for ideas. One key thing to bear in mind here for these assurance providers is that they need to be independent. So you probably can't have the same consultant who's calculating your carbon footprint also auditing your footprint. So just bear that in mind.
Yeah, absolutely. Thanks, Kyle. It's a really good thing to point out. Yeah, so if you're kind of doing all of that this year, then you can take that into 2025, where you're more in a position to execute on the things you've prepared for this year, right? So maybe you have enough data to then do a full inventory for scopes 1, 2, and 3 because you've worked on your data collection in 2024. Continue to have some lessons learned, look for ways to ensure high quality data collection is happening. Maybe finalizing some of those discussions you started to have internally around climate-related risks and opportunities, right? Your TCFD-aligned reporting, thinking about that, maybe thinking about as well some of your mitigation strategies you would need to have in place because that's also required as part of your 261 compliant report. I think Kyle mentioned this, right? You're going to have to make sure you're having consistency among different disclosures with different laws that you are held to. There are definitely overlaps and harmonization between them, but you need to be very mindful of those nuances that you're not just, as he said, copying and pasting without kind of double checking that you've got everything correctly kind of among your different disclosures.
Yeah, that's exactly right. And again, we touched upon this earlier, but it's important to have legal counsel review these disclosures to mitigate potential greenwashing risks. That entails the core aspects of greenwashing mitigation, such as preventing inadvertent overstatements and misrepresentations. And for similar reasons, you'll want to be reviewing these disclosures for consistency with other mandatory climate disclosures, as well as your voluntary disclosures, such as like a CDP report or an annual ESG report. But beyond that, on the legal side, you'll also want to work with counsel to evaluate interplay with other regulatory regimes, including whether the report's disclosure contains any triggers for disclosure under other climate disclosure regulations like AB 1305. So as a quick example, in your TCFD report, if you're reporting on progress against emissions reduction targets and you include a claim about a significant emissions reduction achievement or a carbon neutral status, that could trigger the need for public disclosure under California's AB 1305. So definitely important to have legal counsel on board, both for the greenwashing piece and also the other regulatory interplay piece as well.
Yeah, absolutely. And kind of that would hopefully set you up to go into 2026 where you would be ready to comply. And that last piece there on the timeline I just showed, yes, thank you. So you should have at that stage be kind of more of a well-oiled machine, ready to comply, have your 261 compliant report ready to go, and your audit-ready GHG inventory all set. So the idea being you use 2024 and 2025 to be as ready as you can be for 2026, assuming that timeline holds, given all the things Kyle mentioned. That might throw a bit of a wrench into the plans, but it's definitely worth continuing to operate as though that is the deadline until anything changes.
Yeah, and Samantha, just to reinforce one point on scope 3, obviously scope 3 data collection and calculation is extremely challenging. From a legal standpoint, one tool you can consider using with respect to upstream scope 3 emissions is requiring suppliers to provide certain greenhouse gas data that you can feed into your own scope 3 emissions calculations. That can be done via contract or through reference to a supplier code of conduct. So there are different strategies there. And on that same point, if you determine your company isn't actually subject to SB253 or 261 and doesn't have these scopes 1, 2, or 3 disclosure obligations, you could have customers that are subject to these laws that have their own scope 3 disclosure obligations. And so they in turn could be asking you for your scopes 1 and 2 data. And that could be a voluntary request at first, but that could be a mandatory, a must-have at some point as well.
Yeah, absolutely. So lots to consider as you're working towards 2026. If you're thinking about how to take steps today to get ready for those laws to kick in. So just one last piece that I do want to cover before we transition over to the Q&A, and that is, I think there's a lot of discussion around the cost or the burden related with compliance with these laws. We do want to take a minute to talk about the opportunities here. There's a real opportunity for companies that are being proactive, as you all are by attending today, to comply with these laws, to reap those rewards, to be more competitive, and to really be looking at this from a, how do I gain as a company instead of thinking about, the cost or the burden here. So, there are a lot of ways that you can seize opportunities. I'm going to just highlight a couple of these here briefly before we switch to Q&A. So, obviously reputation, you can really enhance your brand both internally with your own employees and externally with your customers and clients when you are being proactive and seen as a sustainability leader. This is becoming increasingly more important for kind of what people are looking for, both in the organizations where they work, but also where they shop or do business. So being proactive absolutely can make you more competitive and improve your brand reputation. In terms of innovation, the level of transparency that's going to be provided by the fact that the number of companies are being asked to do this and report publicly on this information that maybe haven't had to do this publicly before is a real opportunity to leverage the fact that you might see maybe a challenging area for emissions reductions in your industry, and you don't have to solve that problem alone, right? Identifying that problem means that there are opportunities for you to collaborate with others in your industry, maybe across industries, to help find solutions to those problems and innovate in ways you might not have thought about previously. And lastly, I just want to touch on optimization. Some of these efforts can actually add increased efficiencies in your business model. Just like a very quick example that I think comes up often, but worth reminding. Maybe when you're looking at your GHG inventory, you see some data on your energy consumption. Maybe it's higher than you thought it was. And not only can reducing that or looking into energy efficient options, maybe for your facilities or your offices, decrease your emissions, but it also could reduce costs for you as a business if you are spending less on your energy consumption. So just some examples, things to consider when thinking about how to respond to these laws proactively and the ways that they can actually be seen as advantages for your business. So something maybe to consider internally if you're trying to look at the positive light for how to comply, but also maybe good talking points when you need to talk to others in your business to get them on board when you're working through the steps you need to actually work towards a GHG inventory or a TCFD aligned report that would put you in compliance with the laws. And with that, I will pass it back to Natalia to do, I think, one final poll and start some Q&A.
All right, thank you. I'll actually hold the poll till the last couple of minutes, but this does officially start our Q&A portion of the session. So thank you so much, Kyle and Samantha, providing all the context and hopefully maybe even preemptively answered some of the questions that you had. I see some questions coming through, so please continue to post your questions to allow us to be able to kind of sort through and make sure we get to them all. And I'll start with the first question here. I'm pulling everything up. All right. So first question we see is, do companies use their external auditors for financial reporting for their GHG inventory assurance as well, or do they find someone else?
It's a great question. I'm sure, Kyle, you have thoughts as well, so feel free to jump in. But I think the answer is, I think both cases can be true. I think it's going to depend a lot on, what you're looking for as a business. And I think the other thing to know is that sometimes specialty firms might be able to give you a little bit more insight into your GHG inventory than a financial auditor could. So it's something to consider in terms of pros and cons and deciding who you're working with. Sometimes it can be more cost effective to have someone who's dedicated to a greenhouse gas inventory. So, there are pros and cons, I would say. I wouldn't say that there's necessarily like a right or wrong answer here or one versus the other that's more common.
Yeah, I think it varies. There's nothing in the California laws or even the proposed SEC rule that would explicitly prohibit you from doing this, other than the general independence considerations. So you just need to, keep the independence test in mind when selecting an auditor. But just in and of itself, there's nothing legally that prevents you from doing this. And yeah, the strategies definitely vary across the market.
Great. All right, keep putting your questions in. We also have some very frequently asked questions that I will pose as well. So next is, how are these regulations going to be enforced?
That's a good question. I think we touched upon this a bit earlier. Essentially, for SB253 and 261, CARB is charged with enforcement authority. So they're delegated that duty. They're required to pass implementing regulations around the assessment of penalties. And with respect to SB253, they're also tasked with publishing some fairly detailed regulations around the mechanics of how the law works. So they play a pretty integral role in its actual implementation. Again, we'll keep an eye on the budgeting process and litigation to see how that might affect everything, but it will be CARB that's keeping an eye on compliance, which is a little different from AB 1305, for example, which would be enforced by the California's AG office. So in going back to the budgeting and funding thing, the CARB to require funding to actually enforce these things. And then on the AB 1305 side, where it's the California AG that has really authority to take the lead on enforcing that law, it's sort of up to their enforcement discretion whether they're to be taking a hard stance and stringently enforcing the law. They obviously have they have varying enforcement priorities, I'll put it that way, and varying appetites for enforcing laws like these. So a little bit different dynamics for both those sets of laws there.
Great, thank you. Have a few more trickling in. So if I am already doing a greenhouse gas inventory, do I need to do anything differently in order to comply with these regulations?
That is a great question. And I think the answer to that question depends on a couple of things, right? If you're doing a greenhouse gas inventory, maybe for just scopes 1 and 2, then what you'd need to do differently is start thinking about scope 3, since as we talked about, that is required. You just need to determine your material categories under scope 3. If you're already doing a greenhouse gas inventory for all 3 scopes, then you'd need to start looking at assurance. And so I think, it really depends on sort of where you are with your greenhouse gas inventory in terms of what you're doing versus what the law is asking for. It's possible that you're already doing an inventory on all 3 scopes and you're already getting it assured and you might be totally good to go. But it's still worth kind of double checking that everything you're doing is fully in line with what the law is asking for. So I think it's going to be just kind of varying degrees of effort based on kind of what you're already doing with your inventory to kind of meet the expectations of the law, depending on really where you are in your inventory process.
All right, great. Thank you. All right. One more. I encourage you to use the Q&A. I see there is some chats going directly to us. So next question I see as, do you think other states will follow California's lead and pass similar laws?
Yeah, so as I mentioned earlier, we're already seeing a few states propose laws mirroring SB253 in their state legislatures. So yeah, only propose at this point and working their way through the state legislatures. Nothing's been passed in other states yet, but it wouldn't be surprising to see something passed in other states. And I would expect to see more proposed laws in other states mirroring some of these laws. So it's a distinct possibility. Yeah.
Great. All right, next I see, for companies on a tight budget, where should we invest first?
It's a great question. And I know, yeah, there's definitely been a lot of feeling, I think, in response to these laws that this is going to be really cumbersome for companies to comply in terms of cost. I think, one thing I do want to flag is you don't necessarily need fancy software in order to do a GHG inventory. You can do Excel, you can collect data in all sorts of different ways. It's going to really depend on the needs of your company. And so I think when you're thinking about kind of where to invest first or where to focus first, potentially on your resources internally, that you might have if they're limited, is to think, what do I have in hand already, that doesn't require potentially additional costs, and sort of use that as your baseline to work off of, understanding then where you might need to kind of add additional resources, right? Because that could mean a lot of different things. If you have really high quality data coming in already in different Excel documents or systems internally, and it's about collating it, maybe you need a specific person that you're adding to a team to be responsible for that, and to help collate that data, keep it clean and organized. If you don't have high quality data coming in and you're going to need that potentially to conduct an inventory or to be informed for your 261 compliant report, then maybe your first investment is in those data systems internally. And like I said, it doesn't need to be a piece of software. It could just be thinking about, the processes you would want to set up internally to make sure that data is getting collected in whatever way that makes most sense for you. And so I think that could mean a lot of different things, and it's going to depend a little bit on, where you are and what you're already doing internally as a business. But I think in terms of understanding where to invest first, it's going to be really about kind of taking stock of your current situation and understanding kind of where your biggest gap is to fill in order to be able to comply successfully.
Right. Thank you. I think we'll probably have time for maybe just 1 or 2 more questions, so I'll prioritize ones I see coming in through the Q&A. First, we see, what are some averages for a greenhouse gas audit cost? I'm assuming that's referring to the assurance process that's required by the laws that we were mentioning.
Yeah, I think that's going to vary quite a bit. It could be a lot of different things. I don't know that we have a good average to provide that would be entirely accurate. It depends on a lot in terms of what's in the inventory itself, the kind of assurance you're getting, whether it's limited or reasonable, and you will eventually need both, I think, under the laws. So it's going to vary a lot, and we can also follow up with you directly. If you're looking for more information or a referral potentially for, a firm that does GHG assurance. So we can follow up with you if you're looking for more info there, since I think the answer is it varies.
All right. And maybe last but not least, I see to follow up on other states with similar laws. California is requiring to enter this into their website. Do you think each state will require their own website, creating more work, or do you see this being one disclosure report like a 10K or a corporate sustainability report?
Yeah, I think it's hard to say at this point. I don't know the exact detail on this point in each of the draft laws in Illinois, Washington, and New York, but it's, I wouldn't be surprised if they each, required greenhouse gas emissions reporting to their own, like California own state regulatory agency. And one quick, distinction to make here. It's for SB253 that you have to report your emissions metrics to like a state entity web portal. And then separately for 263, essentially the TCFD aligned reporting that can just be posted to your own website. So it's a little different between those two laws.
Yeah, yeah. And I would say, as Kyle mentions, it's hard to say right now what's going to happen. I could absolutely see it being a case where each state comes up with their own portal for you to put your GHG emissions. And then I think maybe if we hit critical mass, it might converge into one portal. But, I think it's really hard to say right now how that would go.
Okay. Thank you very much for all of the questions that have come through via the chat and the Q&A. Really appreciate it. In the last, 2 to 3 minutes or so, I will pop up one final poll. So let me launch it now. Essentially, want to get a better understanding of what resources would be helpful for you as an organization as you take your next steps in complying with these laws. So it's a text answer. Feel free to be as short or as long as you wish. I'll leave the rest of the session. But we really appreciate the time that you've taken. Please look out for an email with information on the webinar content, the recording, and some materials that K&E and Agendi are happy to share with all their registrants after that go in a little bit more depth on each of the individual laws and regulations that were discussed today. We hope you have a better understanding now of what the regulations mean for your business, how you can best prepare to comply with them, the immediate next steps that you can take moving forward, and then, of course, how we could potentially collaborate and help you achieve compliance in those regulations. So with that, I'll leave this open for the next 30 seconds or so, but have a wonderful rest of your week. And we really appreciate you taking the last hour with us.